High prices of oil and fresh produce, coupled with rising geopolitical risks, are laying a bumpy road ahead for Korea to tame inflation. This as dollar rally continues to weaken the Korean won and drive up import prices, further complicating government efforts to stabilize consumer prices. Meanwhile, U.S. Treasury Secretary Janet Yellen headed to China for the second time in less than a year as fresh tensions mount between the world's two largest economies. For a deeper look into these developments and more, we're joined by Oh Joon-seok, professor of Sookmyung Business School. Welcome to the program.
Good evening.
Also with us is Hwagyun, professor of banking and finance at Texas A&M University. It's great to have you back.
Thank you, and pleasure to meet.
Professor Oh, let's start here in Korea. South Korea's consumer prices rose 3.1% in March, hovering above the 3% range for 2 consecutive months. What's continuing to drive up the prices? And would we be able to see figures come down to the 2% range in the latter half of this year as the government projects?
POK said, and of course I agree, while the pace of inflation would slow gradually, there remains uncertainty about whether we will meet the target of the 2% range or not. Korea's inflation grew more than 3% for the second straight month in March, largely driven by an increase in the price of agricultural products such as food inflation. Agricultural, livestock, fishery products very sensitive to daily necessities has jumped to 11.7% last month from a year earlier. Of major items, prices of apple surged drastically 88.2%, a record surge since 1980s. In addition, prolonged Russian and Ukraine crisis along with instability in the Middle East made the petroleum product climb over 1.5%. As policy responses last month, Korean government came up with the measures worth of 150 billion won to stabilize the produce price. That's because inflation emerged as a major policy issues heading into the election day next week. The government has said that the consumer prices are forecast to ease at slower pace before reaching the target rate of 2% by around the end of 2024. I hope so, but it could be a good scenario in a sense when policy effects materializing, inflation is expected to stabilize from the second half of the year. But it will be very difficult to handle the inflation pressure now in the market due to rapid changing uncertainties in and out of Korea. What is worse, like a working shadow of the financial market, moving into the instability, adding concerns more to amplifying volatility of foreign exchange rates.
So among the primary factors driving up Korea's inflation is the soaring prices of agricultural products. There's also the escalating geopolitical tensions. And so it remains uncertain if all the government policies will be effective enough to bring down the figure to the 2% range within this year. Now, speaking of soaring prices, Dr. Kim, the price of cocoa continues to shatter fresh records, prompting many to worry that chocolate will turn into a luxury item. What's the main cause of the cocoa price hike, and where are the prices headed?
Yes, I think I saw this type of news about 2 months ago, and then at that time, the price of cocoa was around like $5,000 per ton, which is already a big increase. At that time, major reason was the major producers like in West Africa's like Ghana and then these countries having bad weather like El Nino and things like that, and that affects the supply constraints really severe. And because of that, I think prices went up very, just rapidly. But then when I saw the news again, like a few days ago, then the price of the cocoa per ton is now around like 9,500 or slightly now it's going down, but still I think it's hovering around like $9,100 per ton. So it's a crazy increase in almost like 223% per year. And according to the this news, I think the futures price in New York increased very rapidly, actually hovering around 10,000. So probably the price increase is going to be continued for a while. And the major reason this time is not just the supply constraint because of the weather, but also the funding challenges. So it's more financial reasons. I think the funding challenges in Ghana, which is the world's second largest grower, and then the country is about to lose access to a key funding facility. And as this cocoa crop has left it basically without enough beans to secure the money. So the basic thing is when farmers actually the harvest the cocoa, the country's the regulator cocoa bond or the cocoa bond, actually they are supposed to pay farmers money, but then they're going to lose this funding facility. Therefore, clearly this is going to be just worsening the situation. And as you just mentioned, obviously the chocolate companies need cocoa to make chocolates, and it's going to be difficult. So I think they just talk about like increasing the price and also just making it smaller, it's like shrinkflation type of things, and various things actually about to happen or happening already. And clearly, we're going to see this for the time being.
So chocolates already pricey are about to become pricier and are expected to be stay expensive for quite a long time. And you've mentioned that, of course, this is caused mainly by the extreme weather conditions in countries like Ghana and the Ivory Coast, which account for most of the global supply. But there's also the factor, the funding challenges that Ghana faces, which is also putting a strain on the global supply of cocoa. Now, back here at home, Professor Oh, the Korean won tumbled to a 5-month low against the US dollar as the strong dollar trend continued amid a better than expected U.S. economy. It did fall, the foreign exchange rate, it did fall slightly today, closing at 13.47.1. But still, what are your biggest concerns regarding the weakening won?
Yeah, a strong dollar is the biggest reason for the weak one. The Fed might push back at the timing of cutting interest rate. There is no rush for cutting the policy rate. As recent inflation data shows, it is prudent to hold this rate. It might be a situation for the Bank of Korea. Water is boiling in a pot with a lid on. Stove fire beneath the pot comes bigger and bigger. You would like to slide the lid off a bit as interest rate drop. It should, however, be tuned with the Fed rate decision. The BOK cannot be a first mover due to dynamics of international financial market as a kind of complex action and reaction of the foreign exchange rate movement. As the dollar is expected to remain strong because foreign direct investment into the United States from Korea, Japan, and Germany is encouraging. Korea cannot be free due to a strong dollar. On the other hand, the U.S. economy is booming along, driving the dollar's strength keep continued. As long as the U.S. economy exceeds the market expectation, the base rate cut would be delayed, and then sentiment for risk asset preferences slowed, which means Korea resort only to controlling the stove fire within limited range while keeping the lid untouched. Cannot change the interest rate drop, also known as the monetary policy. For the time being, that is the only resort.
And in related question, Professor Kim, dollar strength is deepening underperformance of not only the Korean won, but other major Asian currencies as well, like the Japanese yen and Chinese yuan. Do you expect this trend to last throughout this month?
The short answer is yes, at least for this month. In May, maybe things can change, as you allude, I think, correctly in the question. It is not just for the Korean won, but I think, the kind of basket of the East Asian countries, the major exporters, the currencies weakening. And it's probably because of the Fed's policy now somewhat revised more negatively in terms of the timing of the cut, because the economy of the U.S. seemed to be doing better than, or not like as fastly just as expected, just deflated. So clearly because of that, the interest rate is going to be hovering around like 5% longer. And because of this interest difference compared to the U.S. versus these Asian the big countries in terms of economy, I think clearly the money flows from these countries to the U.S. because of the higher interest actually for the time rate. So for the time being, I think this tendency is going to continue. Of course, at the same time, always exchange rate comes also from the relative export import difference because of that. If so for instance, like Korea exports a lot, then that means the US dollar is going to go into Korea. Then I think that means, relatively speaking, the Korean won's value is going to go up. So I kind of saw news that the Koreans' exports actually seems to get better. So if that continues, probably in May or early June, we will see some the tumbling around of the the direction. But eventually, I think it's going to depend on the interest rate differentials and as well as the overall health of the exporting of the East Asian countries.
So various factors you've highlighted there that now underscores the attractiveness of the U.S. asset, and so it's expected to continue to gain strength for the time being, and at least throughout this month. Now, Professor Oh, South Korea's foreign direct investment exceeded $7 billion in the first quarter of this year, hitting the highest level for any first quarter to date. How significant is this record, and would this trend continue throughout this year?
Yes, as I had worked for the government-run investment promotion agency, I could feel the big difference of the numbers. Foreign direct investment in the first quarter of this year reached 7.05 billion US dollar. Normally speaking, it's just over the 4.5 billion dollars. So when considering this amount, it is a significant increase of 25.1% compared to the same period last year. There are two measuring of this kind of foreign direct investment in terms of actual arrival, normally quarter period gap from the declaration term. The figure stood US 1.85 billion US dollars, indicating an arrival rate of approximately 26%. It is also the faster than average speed of arrival. Mainly two reasons behind the surge of inbound FDI into Korea. First, the surge in inbound foreign direct investment can be largely attributed to the strength of the manufacturing sector, reforming supply chain caused by China manufacturing exodus. Foreign direct investment in manufacturing saw a significant growth of 99.2% compared with the previous year, totaling US $3.08 billion. Significant increase in investment in advanced manufacturing sectors are expected to contribute significantly to the economic revitalization of Korea. Second, transferring the regional division business centers, moving business gravity from Hong Kong to other countries, so-called dual hub strategy of multinational enterprises. Not only for updated security law, it is also related to insulating data sovereignty risks from China, aftermath of re-electing President Xi. It could deter even more foreign businesses already shrinking presences from investing in Hong Kong. Japan and Korea might be considered as an alternative of relocating controlling tower and then data center for multinationals. Despite the sluggish global economic growth and challenging conditions, such as the high interest rate and exchange rates, it will be a relief for foreign investors have confidence in Korea's investment environment and in doing business in Korea.
Dr. Oh, you've highlighted that the rise in foreign direct investment was mainly led by Korea's strong manufacturing sector. And many economists point out that this record comes at a time when Korea still faces a series of headwinds like high interest rates, slow growth, and also weakening won. And so many interpret this as investors' trust in South Korea's manufacturing sector. And so government efforts it appears government efforts are also needed to keep carrying on this momentum by creating investment-friendly environment for investors. Now, Professor Kim, let's talk a little bit about intensifying U.S.-China economic feuds. China has initiated dispute settlement proceedings against the U.S. at the WTO to safeguard its interests in the EV industry. China claimed that the discriminatory subsidies under the U.S. Inflation Reduction Act resulted in the exclusion of goods from China and other countries. How do you gauge the global impact of this?
Well, I think the initiation of this procedure, the WTO dispute settlement proceedings itself, is a significant step, obviously, but its effectiveness, I think, in satisfying China's goal in the EV industry, or the more related, this global impact, I think, is going to be relatively small or relatively uncertain, because it is more like this extra tool for China in talks or negotiations with the U.S., I think, because clearly the China's the settlement proceedings initiation, I think, is a formal step for the WTO, and clearly it's going to be well-made procedures, but which includes like consultations, panels, and appeals and things like that. But the WTO panels, even if they rule in favor of China, which it takes time, so even aside from the time that it's going to take, even if the China is actually kind of winning, therefore the U.S. may be asked to do some, the changes, I think, in terms of their the policy. It can be always just appeal process again, and even after all the appeals, the U.S. can implement this with a very big delay. Then I think this is going to be again like ineffective. Therefore, it is more like the one more chip for China to just talk with the U.S. in bilateral negotiations. And also, clearly, the EV industry is a burgeoning new industry, and also it requires a lot of new regulations and things like that. So clearly, all countries involved, including, of course, the South Korea as well as a major player, will try to just get more market power over time. So this is going to keep happening. So impact is going to be relatively mild, but clearly this is going to set some the stage about the future battles of all these countries who have the stakes.
So the impact on the global economy will be limited because this is more of China's tool to hold extra talks with the U.S., sort of like its extra bargaining chip. Now, Chinese President Xi Jinping, meanwhile, Professor Oh, met with more than a dozen U.S. CEOs and academics in efforts to woo back foreign investors and mend strained relations with the U.S. The meeting came as China's foreign direct investment collapsed to a 30-year low. What's behind the massive outflow of foreign investment from China, and would China regain investors' trust soon?
Due to uncertainty, but I guess not likely to restore investors' confidence. Hong Kong flourished as a finance center and gateway to China from a barren island rock. The skyscrapers of a booming metropolis arose. I really love the landscape at night of Hong Kong. With the security crackdown or passage of Article 23, foreign companies think of leaving. Investment is drying up, and the city's economy might be about to languish as time goes. Some U.S. firms are now using burner phones and then laptops when visiting the city because of data security concerns. Also, I got recommended from the government also to not use my smartphone when I visited China. It might be considered fully as a gradual move toward the kind of internet censorship seen on the mainland. The decision to move out of Hong Kong is often fueled by a need for firms to distance themselves from China amid the ongoing geopolitical tension with the U.S. over the future of Taiwan, the Ukraine war, and then instead of Hong Kong, Singapore and other Asian hubs have meanwhile benefited from the recent U.S. policy of friendshoring, where U.S. supply chains are increasingly prioritized around the countries regarded as allies. Come to think differently, there is a chance moving from a financial center to an offshore hub for Chinese businesses. Chinese firms, Chinese multinationals are wary of listing in London, Donggyong, or New York. Then Hong Kong is the only global financial center that can offer these firms security from geopolitical straits. It might be another gateway to the Western areas.
And Professor Kim, U.S. Treasury Secretary Janet Yellen has embarked on a week-long trip to China, aiming to responsibly manage U.S.-China bilateral economic relationship. The trip comes ahead of the U.S. presidential election in November. What's expected from the visit, and what are the key points to watch out for?
Clearly, I think this is before the election, so I think the current president, like Biden, doesn't want this, the U.S.-China trade conflicts and also the tensions not worsen, at least in terms of like this media coverage and also maybe to some extent actual, of course, contents. But clearly, talk is going to be on various, the aspects, but whether this is going to be really effective in terms of making things really needle change or shift it, it's going to depend on, of course, we have to watch actually what exactly is just talked. But if we just look at some of the points, clearly they try to the Ellen's visit is probably trying to just responsibly manage this U.S.-China bilateral economic relationship, because clearly this current trade relationship doesn't seem to go really well. I mean, they do export and import, but clearly there are a lot of issues, and the U.S. especially is interested in the rectifying the trade imbalances and also the market access issues and concerns related to the intellectual property rights, which we have been heard many times, and also the technological the issues in terms of these EVs and the semiconductors. And also, I think any progress related to the national security about these type of the spying and all this kind of things can be potentially also talked, but I don't know how well this can be talked in terms of this broader technology and the telecommunication sector issues. And also clearly the Yellen's always interested in the climate change. So I think she's going to bring up this issue to China so that these two big countries can be just cooperating. But whether this is going to be effective is a different matter. And also clearly the inflation is another thing. So although the interest rate and things like that are always affecting inflation, but at the end of the day, inflation is commodity prices compared to the money, right? So clearly depending on how quickly these Chinese products actually can be exported at cheaper prices, that's going to also affect the inflation, obviously, in terms of the cost of the actual goods. So I think this is going to be also discussed.
So the U.S. and China, they'll touch upon a wide range of issues, including EVs as well as climate change, but it remains to be seen if the talks will be effective enough to settle their disputes.
I think so.
All right, thank you so much, Professor Kim and Dr. Oh, for sharing your valuable insights.
Thank you for having me.
Thank you.
And that brings us to the end of the show. Thank you for watching, and be sure to tune in same time tomorrow to join our conversation. Goodbye for now.